Americans are spending more money than ever before, even if they don't have the money to spend. And this is a sign of how strong our economy is. At least that's according to economists who say that not even a recession can hurt our spending here in America. And what this article says is that there are three main factors which are contributing to the growth and strength in spending here in America. Number one is the money printing that we saw. Number two is the Social Security program, which has been growing thanks to money printing. And number three is people borrowing more money to continue spending. Now, the reason why this is so important to understand and that we're going to dive into this for is because everybody's talking about how strong our economy is because consumers are spending so much money. But at the same time, this consumer spending is a double-edged sword because if consumers spend too much money, that means eventually they're going to have to pull back on their spending. And when they pull back on their spending, and businesses are reliant on consumers spending more and more and more money, that's when you can start to see a real shakeup in the economy. And what you'll see is that there are real flags with why our consumer spending is so strong right now and why people believe that not even a recession can hurt consumer spending. So let's jump right into this. And let me start by talking about number one, which is how the money printing in 2020 and 2021 is still affecting our economy today. Now, by now, if you've followed anything that's been happening in the financial world over the last few years, in 2020 and 2021, the government and the Federal Reserve Bank worked to print and spend trillions and trillions of dollars and gave this money to businesses, corporations, and people, which gave people more ability to spend, which allowed businesses to create more jobs, which allowed businesses to raise salaries, and which allowed people to pay down their debts, which allowed people to build some investments, and which allowed some people to build their savings. And what this article talks about is the impacts of this money printing today. It says that massive fiscal support during the pandemic and constraints on consumer ability to spend allowed households to accumulate a large stockpile of excess savings, and consumers have been tapping on those funds since the summer of 2021. Now, this is where you're probably thinking, Jaspreet, we're in the middle part of 2023. It's been over 2 years. How does that spending and money printing still affect us today? Well, take a look. Households have likely depleted more than half of their savings buffer, but there's still somewhere between $500 billion to an excess $1 trillion in spending ability out there, meaning people still have more ability to spend because of all the money printing that happened. And you might be saying, but Jaspreet, that was 2 years ago. How does that still affect us today? And I think the difficult part that a lot of people have of understanding is how much money was actually created during the 2020 pandemic. Because when the 2008 crisis happened, when we were talking about a potential $1 trillion stimulus package back in 2008, people were losing their minds, and that was considered impossible to do a $1 trillion stimulus package, so things had to be cut. In 2020, not only was a $1 trillion stimulus package considered not enough, there were multiple multi-trillion-dollar stimulus packages created and spent, in addition to trillions of dollars with the quantitative easing, in addition to trillions of dollars of infrastructure packages that were created and passed. The amount of money printing that we saw in 2020 was many multiples of what we saw during the 2008 crash, when people thought that we had printed more money than anyone could have ever imagined. And we took the 2008 money printing to a whole new level in 2020. And so apparently, according to economists, and even banks have been talking about this, consumers still have more ability to spend due to still today in 2023 excess supply of capital from the money printing in 2020 and 2021. But it gets even more interesting when you take a look at number two, which is the Social Security aspect of growth and spending. Now, this is a story that we did cover in Market Briefs. Market Briefs is my free financial newsletter. If you have not joined Market Briefs yet, I highly recommend you do so because it's an easy and free way for you to stay up to date on what's happening in the top finance and business news. So if you're an investor and you want to stay up to date on what's happening in the economy, the housing market, the stock market, the global economy, our own economy, into a fun, witty, and easy to read email that we don't get blindsided by what's happening, Market Briefs is a free resource to help you do that. You can read it in less than 5 minutes every morning. So if you haven't joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I'll also link it for you down in the description. below. Here's what the report had to say about Social Security and consumer spending. And by the way, if you want to read the whole article, I also got it for you down in the description. But what it says is that generous cost of living increases for recipients of Social Security benefits have raised consumer spending. Now, this one is really interesting because if you've looked at what's been going on with Social Security has been drying up. Number one, because people are living way longer, so Social Security has to keep paying out people's benefits longer and longer and longer. And then number two, because the cost of living is rising, so Social Security benefits have to rise faster than expected. But take a look at what it says next. Social Security beneficiaries received an annual 5.9% increase in benefits in 2022, which was the largest in 40 years. And then they saw an 8.7% increase this year. And this new income, Social Security checks for old people, is of growing importance in the economy because as the elderly population increases, more people have more spending ability. Now take a look at this. We have a growing elderly population, growing people that rely on Social Security. This is a huge chunk of the consumers in America. And what this article is saying is that because we have more old people in America that are getting bigger checks from the government, they have more spending ability. But the reason why they're getting more checks is because we have more inflation. The reason why we have more inflation is because we saw more money printing. And the way that the government is funding these bigger Social Security checks is by printing more money, which causes more inflation. So if you start to look at this from a true wide lens, what you see is the inflation caused the need for more Social Security checks. The inflation was caused by more money printing. So more money printing in 2020 and 2021 caused the need for bigger Social Security checks. Now the government has to fund bigger Social Security checks through more money printing. And so now because people have bigger Social Security checks, they can spend more money. And they have to spend more money because the prices of groceries, rent, and everything in between is so much more expensive. And this is a big part of our growing economy, is the spending that old people have through Social Security checks. And because Social Security checks are growing, they're able to spend more money, which is growing the economy. And they're getting the source of this money from the government. And the government doesn't have the money to fund this because the Social Security fund is depleting, and the way that they're funding it is through more money printing. So you start to see the circular argument where you have the inflation problem and you're fueling the economy by producing more inflation, which creates a bigger inflation problem, which starts to create more economic issues. So this is something you want to pay attention to because a lot of people have been reporting about the retirement crisis that's going on. What is a retirement crisis? That more and more Americans are entering retirement with not enough money. So what are they relying on in order to fund their retirement? Social Security checks. But the Social Security fund has been drying up because now the money you're paying into your Social Security fund, because anytime you get paid from your salary, some of the money is going to FICA taxes. What is that? Social Security taxes. Those Social Security taxes that you're paying today, especially if you're under the age of 45, aren't going to fund your retirement. They're going to fund somebody else's retirement. They're funding somebody's retirement today. And this is where now, in order to fund these growing Social Security check requirements, which are necessary due to the higher inflation, the government has to create more inflation. So this is a definitely indicator of something that you want to be paying attention to because, well, the inflation problem has not ended yet. And the third factor that's contributing to this booming consumer spending is debt. Take a look. Households have also been boosting their borrowing to maintain spending in the face of high inflation. Many households paid down credit card debt after stimulus checks were sent out, but now we've seen credit card debt jump by 14% in 2022. We here in America live in a credit-based economy, and our economy runs on spending, which means the more money you spend, the more money somebody else gets. If you spend more money, somebody else is getting richer, period. Now, we live in a credit-based society, which means you don't have to just spend how much money you earned. You have the ability to spend based off how much debt you qualify for. So if you go to work and you earn $1,000 and you keep the $1,000 in your pocket, that's not stimulating the economy. That's not making somebody else rich. But if you take the $1,000 and you go and you spend all of it at the Nike store, at the Gucci store, at the Lululemon store, well, now you're making somebody else rich. Because now these businesses are making money and their profits go up. They can hire more employees. They can create more jobs. But because we live in a credit-based society, banks will look at you earning that money and they're going to say, oh yeah, you got $1,000. How about we give you a $2,000 line of credit? So now you have the ability to spend the $1,000 that you earned plus the $2,000 worth of debt, your credit card debt, whatever line of credit that you have. And now you have $3,000 worth of spending ability. So now when you go to Gucci, Louis Vuitton, wherever, and you spend the $3,000, now the people that are getting that money are getting even richer faster because you have more spending ability. And what happened during the pandemic was all this money was printed and sent out, which meant people's debt balances from across the board went lower because some people used their stimulus checks, unemployment checks, free money from the government to pay down their debt. So people's debt levels went down. Well, now what we've been seeing is incomes have gone up, partially due to the inflation. So now people's incomes went up and their debt levels are down here. And now banks are saying, hey, you don't have any debt. You have more income. You're more credit worthy. How about we give you bigger credit lines? How about we give you more home equity lines of credit? How about we give you other options to borrow money? And now what we're seeing happen today is more and more Americans are digging into debt to continue funding their lifestyle or to continue the ability to live. Because now, normally, people would have already had debt and they can't keep going deeper into debt. But because people got this like running rewind on their debt levels in 2020 and 2021, they have the ability to rack up way more debt today because, well, a lot of people just zeroed out their balances and now they have to rebuild it back up. And they have more room to go because if incomes have gone up, your credit worthiness have also gone up. But the problem with this is there's a breaking point. Because you can't just keep borrowing money forever. Eventually, you're going to max out your credit card. Eventually, you're not going to be able to pull out more money out of your home. And when that happens, now people are going to have to make a decision. Are you going to work to earn more money to continue funding your lifestyle? Are you going to dig into your savings to keep funding your lifestyle? Or are you going to have to cut back now because the bank is pulling the strings back? And when that starts to happen, that's when you'll see a big shift in spending, because there will be no other option. And this is that concern that a lot of economists are looking at. It's because they're looking at the economy and consumer spending, which is booming today. It's causing profits to go through the roof. It's causing markets to grow. It's causing everything to be good. But that comes with the time span too. It's a ticking time bomb because debt levels are rising. Inflation is still there. Interest rates are rising. People are spending like crazy. People are digging into the savings to spend. But eventually, people can't keep digging into the savings anymore. Eventually, people won't have the ability to go deeper into credit card debt. I mean, we've been seeing debt levels rise at some of the fastest levels we've ever seen. And part of the reason is because the prices of things have gone up so much. And the other part is because people want to keep spending money. And when that hits its tipping point, that's when you're going to see a real shift in the economy. And so this is where you have to understand, number one, how does our economic system function? We live in a spending economy. The more money somebody spends, the more money somebody else makes. But that spending isn't just spending based off of money. It's a credit-based economy, which means people spend not based off how much money they've earned, but based off of how much credit they qualify for. But when you live in a credit-based economy that relies on spending, there's also a limit to how much spending somebody can do when they tap out their credit limits. Because now when you tap out your credit limits, people have to stop spending and then they have to start saving. Because now they have to start working to pay down their credit card debts. And when that happens, and people start taking their $1,000 that they earn and use it to pay down their debt, and they put this money back in their pocket, instead of going to Gucci, instead of going to Lululemon, instead of going to Chipotle, well, that's when businesses start to see the revenues get hurt. And when businesses start to see the revenues get hurt, well, that's when they have to start cutting back. And when they have to start cutting back, that's when you start to see more pain in the economy. When people start losing their jobs. When people start losing their jobs, that's when you start to see that negative spiral. Now, normally what has happened in the past when you see this type of downturn is the Federal Reserve Bank will start cutting interest rates to start inflating, to start stimulating. But the difficult part today is we're already facing the high inflation problems. That's what makes this economic situation that we're in right now so unique. There's still spending ability out there. Consumers are still spending. We're still seeing that. Why? Well, this article says 3 reasons. Number 1 is because of all the money printing. People still have the ability to spend. Number 2 is because of the Social Security check growth. And number 3 is because the ability for people to go deeper into debt. Well, eventually, when spending slows down, that's when you're going to start to see the shift. And this is where your job as a financially smart person is to understand this, be financially educated, be prepared, meaning be smart with your money today. 2023 is not the year for you to go out and finance a new truck. Be smart with your money today. That way you can protect yourself, but then also put money aside to be able to capitalize on opportunities that might come your way. Because the reality is when you see economic crises, when you see turns around in the economy, when you see market downturns and crashes, That creates opportunity to build wealth, buy more investments on sale, but the only people that can capitalize on it are the people that were, number one, financially educated to see the opportunity, and number two, are prepared with cash to seize the opportunity. It looks like home prices are finally dropping. Let me read you the title of this article from Reuters. U.S. existing home sales edge up, but prices drop by the most since 2011. The article goes on to say that the median sales price was $396,100, which is a 3.1%